It's an interesting time at the moment because there's very good reasons why dollar-based buyers should be looking avariciously towards the London market.
Well, it's a complex picture, I think. The dollar is keeping the market buoyant. The dollar strength against the pound is keeping interest alive in the market.
Well, it's interesting. The turmoil in the markets, as it's being, suggested is going on at the moment. Actually, there have been some short-term changes in interest in the currency rates, and they are fluctuating, and the interest rates are clearly going to rise after a long period of having been very, very low.
That's a very interesting question. I think the answer is nobody really knows. Obviously, events have rather overtaken reality in this country in the last. We're on our fourth Chancellor of the Exchequer in 15 weeks.
Well, I mean, we're in a particularly strange market at the moment, what with interest rates being on the rise, and there being quite a lot of instability in the market. So we're dealing with challenging times, probably the most challenging, I think, since 2008 credit crunch crash.
Well, it is genuinely an inflection point potentially in the market, and it's everybody's asking lots of questions. No one's sure quite what's happening. So what's going on in the market is we've had a very busy period. The market's very nuanced, it's very tricky to read. You can't really apply one rule to the whole of prime central London. There's, depending on which village of London you're referring to and which segment of the market in terms of price, and largely apartments and houses have behaved very differently.
Well, basically, it's all over the show. I mean, there's all these predictions of price drops and grey doom.
Well, I think right now we're in the eye of a storm. What has been really interesting is the amount of American and Canadian buyers that we've had as a consequence of the dollar, and the currency trade has been incredibly important. Similarly, the euro trade. A purchaser of mine is looking at something at 5 million, and only 5 weeks ago she was looking at something at 4 million. So she's made an enormous amount on the currency trade. So it's a meaningful transactional win. And so we're sticking to anybody with dollars like glue.
Very interesting. I think that we are having the same thing that the financial market is having. We are having a mini crisis, and this is, to a certain extent, making lots of people very nervous. And when there is nervousness, there is inaction, or things take much longer to happen.
It's a bit of a challenging time at the moment in the market. It sort of can be described in two tiers. It's sort of what's happening right now and where do we think we'll be at the end of the year.
A stat recently on a 52-week high and low on the US dollar base to the sterling, and actually at that time when the sterling was at 107 currently and the high was 138, that represented nearly 22.5% discount for US dollar-based buyers to come to London. However, these things are very fluid. But overall, I think there are deals to be had. There are vendors who are keen to sell, but no one seems to be under any severe pressure.
There doesn't seem to be a lot of urgency to actually transact. So I've got a really long buyers list, probably longer than I've had for a while. And I've got a shorter deal list. So there's a lot of people looking. They come, they look, they get excited, they go back home. A lot of them are foreign. They go back. For me, a lot of them are from the Middle East with dollars. And then they are still on the fence. They still haven't committed. I think they feel that there's more of a discount coming.
It's a sort of steady as you go, but we are having to do far more viewings to secure any form of offer these days. It's not like the frenetic year we had last year, which was far more frenetic. But the buyers are there and they want to do business, and they're very well qualified. They're ready to, if they see the right thing for them, then they'll go for it. It's got to have more green ticks than red crosses. And if there's any form of don't like it, they'll just move on to the next one.
I think the main thing that prevents central London from being a proper market is the very high stamp duty and the capital gains tax to those who are offshore, who used not to pay it, and therefore their attitude to buying in central London versus what it was 10 years ago. Having gone sideways, in my view, the prices for the last eight or so years, since 2014-15, when George Osborne brought in high stamp duty and capital gains tax for foreign investors, I don't see central London property prices dropping, largely because I think that the lack of supply caused by the illiquidity in the market will sustain the prices. One thing I do see, though, is that those who are landlords, private landlords who have debt, their problem is that now that George Osborne brought in taxes for, you have to pay tax on the income and before you can offset the interest, whereas before you could offset the interest, or if you're a corporate landlord, you can offset the interest. Those private landlords who have to pay tax on their income and then fund their interest payments on their buy-to-let mortgages, if their mortgages go up in interest payments go up, then they're going to suffer and probably be underwater in terms of funding those properties.
Look, I mean, there's been some very big deals done. Fantastic deals, at least 10 or a dozen really spectacular deals, upwards to 100 million, between 50 and 100 million, or 40 and 100 million. And, you know, that's great. But going forward, we'll see.
There's a lot of caution in the market. The pound being what it is, having fallen quite a bit against the dollar, has meant that there are buyers from overseas or dollar-based buyers looking to pick up what is relatively a bargain for them now in London, but there is still a lot of expectation of potential falling prices over the next couple of years especially. So we're seeing bargain hunters back in, and I think what we'll see from the market for the next, well, foreseeable future, I think. It's too early to say how long this might continue, but I think what we'll see is a market that's based on cash buyers looking for very good deals.
So lots of people are asking lots of questions. Buyers are a bit hesitant suddenly. They're not quite sure whether they should buy at this moment or not. I think primarily people who are already in progress, who found something, got their mortgage rates fixed and agreed, they're wanting to proceed. Some of them are using this as an opportunity to renegotiate the price a little bit at the last minute.
Very likely to be a correction, I think, in prices for people who have to have a mortgage if they want to buy, because affordability is so much higher than the last time interest rates were, you know, let's say 3, 4, even 5%, which is actually not such a high rate historically, but the affordability factor has changed so much because property prices have increased so much. So when the last time people were borrowing 4 or 5%, prices were, you know, almost half what they are now.
And there's another segment of people who have not actually found something yet, and they're now a little bit more cautious than they previously were. And then, as if that wasn't sufficient, there's also, as everyone is talking about, there's a significant dollar-based, US dollar denominated based segment of the market who are by and large seeing this as their Christmas is coming all at one time. It's like all the stars have aligned in perfect symmetry for them. On the basis that if you're buying an apartment in prime central London at the moment, you're benefiting from approximately 10%, on average a 10% reduction from the historic peak back in 2015, and an additional dollar-based sterling transactional exchange rate benefit. So you can end up, there's a benefit of up to about a 30% discount from the historic peak back in 2015. And if you're buying a house, it's a little less because houses have gone up more, the value of houses has gone up more. So it's about a 20% discount, dollar-based discount if you're buying a house. So there are lots of people out there who are just seeing this as a great opportunity. They are people who are familiar with London, they know London well, they've seen historic ups and downs, they've seen some of the cycles previously, they're confident, they believe in London, they still see it as a top global destination, their families are here, their businesses are here, their kids are in school here, whatever it is that draws them here in the first place. They could go anywhere, but they still decide they want to be here. And frankly, they're seeing that as an opportunity to buy a good house in a good street or a good apartment in a good block at a rate they previously wouldn't have benefited from.
So anyway, I think really it's been an extraordinary 5 weeks. It's really been an extraordinary year, you know, having recovered from COVID, you know, and the fallout in the property world from the sort of the COVID stresses. And then we had the stresses around our actual government and who was running us, and the shenanigans around the leadership contest, etc. And now this. I mean, it's been very difficult to manage. But I suppose overall, I would say that as long as you remain completely calm and the agent that you instruct is a true professional and comes with lots of years of experience to navigate you through this, everything will be fine.
We've got a couple of clients. She's actually European, she's Liechtensteinian, and the husband's American. She wants something in Europe. They have a huge apartment in New York. Lovely, straightforward couple, but they want a pied-à-terre in London. So we've been showing, we're going around Mayfair, and last week we're going around Belgravia. Now we saw a first and second floor in Eaton Place, and if people are predicting that there might be a problem with the market, well, that flat had the third viewing on it from another American who also wanted somewhere as a pied-à-terre because of the dollar. So one thing counteracts the other. At the end of the day, at this level of the market, it doesn't matter what's going on out in the world there. If they want something, they will buy it. It might slow slightly, but this level of person, if they want something, they'll just go and buy it. It's always been the case.
Our prime, super prime real estate is an asset class. It's not just a home we live in. It's a very important asset. And the super prime area is, you know, you can only buy it when it comes to market. It's a bit like a rare picture. You can't just buy a 2-bedroom flat in Cadogan Square when you want to. You have to wait for it to come up. So I think because there's a sort of shortage of supply and demand, and that remains in place, especially in times of stress in the market, what happens is that our clients actually don't sell. So ironically, you have a sort of a situation where even though the market could be have lots of property by which you could buy, you actually don't, because what the rich do is they just take their properties off the market. So you have this sort of paradox that when the very rich, when the tough gets going, they just retreat. And because a lot of my area is not driven by mortgage sales, they don't have the kind of stress of that.
Right now we have a bit of a perfect storm in terms of rising prices, an energy crisis, we have rising inflation and rising interest rates. Now that is creating a bit of a havoc for the mortgage market itself, where a lot of lenders are pulling off rates, making it more difficult for buyers to purchase properties. We've seen a lot of properties that have been agreed at good prices, gone to the valuation stage and come back recently at anywhere between sort of 8 and 15% off their agreed price. So you can sort of see that lenders are very cautious about what they're giving out in terms of rates, and where they can, perhaps, are pulling back slightly on the market. Rates were 3 to 4% a week ago, are now being reoffered at 6 to 7%. So for those buyers requiring financing, it's a challenging time right now, and we're seeing a lot of people sort of just taking a step back, and unfortunately quite a few people being burnt, for lack of a better word. However, if you are a cash buyer, particularly sitting in dollar denominations, you're seeing a massive saving. I mean, the currency transaction in terms of costs is about 30%. Year on year, so that's a huge saving. And also with cash, as we always say, cash is king, so you have a negotiating power as well, which means that there are potentially some incredible deals to be had. And that's the short term. And where do we see at the end of the year? I suspect mortgage rates will start to level off. I think there's been a lot of discussions about sort of 6, will it go to 7%? I've heard various conversations from lead economists from PwC and various other accountancy firms who are a little bit less skeptical, and they sort of think around 5 is probably where we'll end up. But a 5% interest rate is a huge difference to the sort of market we've had over the last, well, since the credit crunch in 2008. So affordability will take a hit. I think prices will probably going to have to be reflected in that way as well.
Interest rates, inflation, money. That's the average person. We also have here The same thing that happens when there is chaos in the financial markets. That represents opportunities to many other people. All those are dollar-based, or maybe not even necessarily dollar-based, are cash. They know that potentially in a few months, there are going to be many opportunities. So they will just sit and wait.